Yesterday, the Federal Reserve Board voted 5-2 to lower the capital ratios for the U.S.'s largest banks, those that are systematically important, such as J.P. Morgan, Goldman Sachs. What does that mean? Does that mean banks are going to be more risky now? Not necessarily. I mean, it is a couple $100 billion less of a capital buffer that the bank holding companies, subsidiary banks need to hold. But it's important to recognize that banks already have to adhere to Tier 1 capital ratios. That's the amount of capital buffer they have, the retained earnings, the equity capital, some preferred stock, divided by risk-weighted assets. So the more risky the asset, the more capital they have. But these enhanced supplemental leverage ratios that the biggest banks had to adhere to were just capital against total assets. It didn't matter what the particular risk was. So that they had to hold the same amount of extra capital for holding Treasury bonds as they did for junk bonds. By lowering the amount of capital as part of this enhanced supplemental leverage ratio, it will allow these bigger banks to participate more fully in U.S. Treasury market and do so as the national debt gets larger. And if there's some type of stress event, a lot of money moves in to these big banks in the forms of deposits, which means they would have had to hold more capital because of that. So this should allow more ease within the Treasury markets without taking on much more risk for the nation's largest banks. Admittedly, capital ratios and risk capital is confusing, but we shouldn't be overly alarmed by this change.